And we'll deal with the stag or the stagflation part is if you have exceptional growth. I mean, if growth is just like we're powering through, hey, all right, not a bad thing. Like we'll get through it. It's just cyclical, not a problem. And one could make the argument that this infrastructure bill and the trillions going towards battery energy metals and the hopes of AI maybe creating taking some jobs out, which is tough because that's tax revenue, but maybe increasing efficiency and productivity and driving wealth creation. It's not quite doing it yet, but the hopes of those, how soon is that as well? Like if we look at, say, a battery energy factory or say Volkswagen coming in or Stellantis, go, okay, they're going to build in 2026. Go, well, that's, someone goes, wait, that's years from now. What do I deal till then? Like if this isn't going to hit till after 2025, 2026, are we going to be in pain until the growth happens? So this idea that maybe we all have this stagflation idea of inflation's creeping up, we don't have the growth that can absorb it right now, and we're set in this kind of homeostasis is very uncomfortable. Is that, am I getting it right? Or
yeah,
somewhat?
I think it's a bit tricky because, and I'm not an economist, so I guess it's even trickier for me, but the way that we kind of get an idea of what the economy is doing. Okay, so we're looking at a lot of data that's released by government statistical agencies, right? So the labor numbers, which are huge, the inflation numbers, producer prices, consumer prices, these sorts of things. It's probably of greater use to look at things like electricity usage, petrol usage, rail car loadings, these sorts of things. Now, when I look at that, so let's say, I see some things that are somewhat contradictory. So I see oil demand and take up expanding, right? I see coal usage expanding, okay? So these don't suggest that there's some sort of economic issue on the horizon, right? When you look at the labor data, again, same thing, right? Now, the energy usage is a bit different because you're looking at, people are either using electricity and petrol or they're not, right? Some of the other stuff, how you measure the labor market, anytime you have to depend on a government statistical agency, okay, so now you're in a different game.
Yeah.
So I would say I would pay attention to the data that's coming out of the real economy.
Yeah.
Right. So on that score, what we're seeing is you're not seeing explosive growth, but you're not seeing anything necessarily falling off of the table. And part of the issue is, the world is sort of bifurcating, right? So broadly speaking, you've got the West, and then you've got the BRICS, and the economic setups, both near and long term in the BRICS are superior to what we're seeing in the West, and they're actually getting better. So a lot of the drag that you're seeing in the global numbers is really coming out of Western economies, partly because they're just marinated in debt, right? And so when that happens, you'd say, well, okay, so there's this much debt, so there's going to be a debt deflation, so things are overall deflationary. Well, that can be true within limits, right? If you've got too much debt, what you're doing is you're taking growth out of the real side of the economy, and a bit of a paradox. It forces you to inject more debt into the economy to get more growth,
Yeah.
right?
Yeah.
What ends up happening, unfortunately, is it can create sort of an inflationary spiral, not unlike something that was seen in Argentina, right? So you have debt and you have inflation. You're like, well, wait a minute. When you've got that much debt, there should be something deflationary. And that's not always true. So I think a lot of the assumptions that we've made that can happen within, say, a range of normal outcomes, right? I don't think we're in that range anymore. So a lot of the assumptions that we're making, for example, I said stagflation at the beginning, and that's not something that's been seen for a while,
Yes.
right? It was sort of out of the norm of outcomes that could be expected. So I think with this much debt, you could get an explosion in inflation. That inflation could actually translate into growth in other economies that are commodity suppliers, for example, that have very low debt. Russia has the lowest debt burden of anyone in the G20. A lot of people don't know that.
Yeah.
So, the Russian economy can deal with a 17% interest rate.
Sure.
10% might bankrupt the West.
Yes.
So things have gotten into extremis. So if you go back to what BlackRock and JP Morgan are saying about the 5 to 7%, well, just bear in mind, as you get to a 5% 10-year rate, and you're on your way to a 7% 10-year rate, the pressure increases at an accelerating rate.
Yes, yes.
Because now we've got an issuance need that is starting to increase, not like this, but more like this. And so when that happens, the stresses and the risks, they increase quadratically.
Yeah.
And again, I don't think that's really part of the mainstream of thinking.
No, and you've mentioned something, and this is a perfect segue into how can someone in a retail capacity, just mom and dad sitting at a coffee table, you're talking about, say, a lot of these mining companies, they don't have a lot of debt. And there's a lot of commodity companies, they don't have a lot of debt. They've done a lot of equity raise, which they've been punished, say, in the last couple of years, some of them. But is there an opportunity there? Because if someone looks, they go, well, you're telling me bonds, it's not good. The U.S. dollar, maybe there's some safety there to some degree. My equity portfolio, unless AI takes off, maybe it's stagnant for a year or two. But I do believe this transition's happening. But I believe that this whole world is shifting. I believe that we need, this notion that we need to have a supply chain of critical metals. What can someone do? Okay,
so how patient can people be? How patient can people be? And so I'll use an example that I think a lot of people really just are totally familiar with, right? So if you look at the S&P 500, for example, and I did this. I pulled up a chart. It's a 40-year chart of the S&P 500. And when I looked at it, I just said, this has got to be the most perfect set of circumstances. If you're thinking about buying the dips, it's hard to find the dips. You don't see much volatility. It's hard to find the crash of '87. It's hard to find the dot-com crash. The GFC is a bit easier to see, but it's barely a blip. Okay. That said, blips can be painful. So if you were not living through this on a day-to-day basis, you would think this is, and it was an incredible way to invest. If you could have done the perfect thing, in 1982, buy a barbelled portfolio of 3-month T-bills and 30-year non-callable treasuries, S&P 500, the highest dividend-paying stocks, maybe 20 of them, and then just didn't do anything for 35, 39 years. Yeah. You would have been you would have been the top performing money manager, yes. I would have thought. Yeah. But of course, that's not realistic. So what I'm saying is these long trends, they do take time to play out, and getting caught up in the day-to-day is psychologically hard. It can be to your detriment. Yeah. You could take decisions that you'd like to have back. So, where are the valuations? In the resource sector, right, by most metrics, that's where the values and the valuations are the most compelling, right? I would then, defer back to the S&P 500 chart comment. Values were compelling in August of 1982. It wasn't until, I think, shortly before the crash of '87, people actually began to accept that maybe we're in a bull market. It had gone on for 5 years, and then they went into it, and then October happened. So you have these things happening. Yeah. But those that counter-traded, that believed in the long-term cycle, that understood that, wait a minute, we reached an historic high in bond yields in 1982, right? And yields have been falling. You looked at dividend yields. Some of them were approaching double digits. Corporate balance sheets were just rock solid. The environment couldn't have been better for buying into quality equities. Yeah. And so you get these setups every few decades. You have to be patient to stay with them, would be my suggestion. As far as the bonds are concerned, that's a different game, it's a different world, and they operate differently. They have a maturity, right? So there's an argument for keeping cash in T-bills, because right now, they're paying 5.5%. Yeah. They weren't doing that 3 years ago, right? You can't really do that in the banks because the banks aren't. And part of the reason the banks, aren't paying that is because yields have moved so fast that their funding costs today have outstripped a lot of the average yields in some of their loan portfolios. So, I mean, this is a way of them trying to control their funding costs. Yeah. So, that would be my read on it. So, I mean, people have to have some patience and let trends and cycles play out.
No one likes to ever hear patience, but it's true, especially right now. And I love that comment too, is that it's fun to look at your account in an up market every day and get excited. If things are in chaos, it's better to have a reimagining of what you have. And this is why I love this conversation, to look and think, wait, we're in a different environment, and to see, is your strategy recognizing this new environment? Talk to your planner, talk to your advisor, have that conversation. More importantly, you can also send a message to you to see what's your solutions, because you have some solutions, and I want people to reach out to you,
right.
and we'll give you your email and whatnot, contact information. They can speak to you directly. And obviously, we're a commodity background, and I think we talk enough about it to understand that we're in an interesting situation right now, and there is, like you said, a very compelling argument for the solutions that you're offering as well. Maybe if you just kind of give us a bit of a summation and a conclusion as to, and even maybe a hint of what you'd like to leave with people to reach out to you.
Well, I'd say firstly, sort of recognize the situation, that you're in. I think a lot of, many financial planners, advisors, brokers, wealth managers, what have you, because their businesses have been built, and you can't argue with the success. I mean, although I think making it, attributing, these successes to the 60-40 strategy, I think is incorrect. I think people need to be honest and say, we have benefited from a 40-year cycle of the falling cost of money, both on the liability side for people who are borrowing it because they can see that in their own mortgage rates or what used to be their mortgage rates, and on the asset side, as yields and rates have fallen, stocks and bonds have risen. So I would encourage a discussion, and it probably won't be that easy because, as I said, a lot of people, a lot of these managers, these firms, have their business models invested in this idea. So for them to say, okay, 60-40 doesn't work and it's not going to work for a while, I mean, what is that going to, realistically, what is that going to do to their client base? What's that going to do to their business? Sam, thanks for being honest. We're going to go to somebody who's, so there's that. And I think that's going to be the biggest challenge. The other challenge is, what does the math look like? I mean, how close are you to retirement? People that expected to retire might have done so based on, a number of things. Okay, so the stock portfolio being valued at this, mostly being able to sell the house at that. This is what we'll get, and then we'll, go live in Naples, Florida, or whatever they're doing. Well, my thinking is those metrics, have moved, right? The maths has changed. So maybe a conversation with an accountant, an honest conversation to figure out, where you're at, what you need to do, if you need to make some adjustments. So I think it's less of a, how do I invest? I think it's a bit more fundamental than that, because if someone were to say, okay, right, get out of all of this and go into resources and agricultural land and Russian equities and so forth. I mean, it might be very intelligent advice, especially if you look at it, cyclically, if you look at it structurally. It might be great advice. Go long Argentina. Positive on Argentina, by the way. But what does that look like? How do you actually execute that?
Yes.
And really, outside of the largest investment firms in the world, outside of that, you'd be dealing with specialists.
Yes.
So you'd have to find the
Yes.
specialists. You'd have to vet the specialists. That's not going to be easy. So, people would need to start now. And again, does this mean breaking relationships with longtime advisors? That's a that's sort of a how do I feel about that kind of thing.
Yes.
So it's not going to be easy.
No.
It's not going to be easy. And I think you will be able to read the movements of people in pricing as they make these tortured decisions, right? Some people are going to have to. I mean, if you look at it from one point of view, I mean, you've got some people suffering from mortgage pressure. So they're going to have to sell property.
Yeah.
They do that. Could be a blessing in disguise, depending on how they're able to get out of it, right? And then that was money they might have thought about putting with advisor X, but someone says, well, maybe advisor Y has some ideas that, could make some sense. And then again, they might be going to a different portfolio paradigm, which is in alignment with this reality.
Yes.
Right. So I don't know. It's a hard call because I think the decisions to make are going to be overwhelmingly emotional. Should we sell the house?
Yeah.
Right. There's going to be opposition there. Should we move advisors? Opposition there.
Yeah.
How are we going to allocate this?
Yeah.
Right. And so I'm not suggesting that advisors are going to advise in a direction that preserves their own business. I'm simply suggesting that it is a lot of the skill sets aren't out there, which is another issue. So there's a lot to really pick through.
Yeah,
it's not going to be easy.
It won't be easy. I mean, even just mentioning there, you think of pensioners that are, they've got a RIF, they're getting 3% on it, and you go, well, what's that look like in a couple of years if they need to get 9 out of it? They're not getting it. That was money they counted on for their plan to just live, to pay the bills, to make sure everything was okay. So we won't get into that though, because that gets into more like financial advice, but it's things to bring up. And I think it's important that people start becoming familiar with this conversation, as uncomfortable as it is. We're certainly going to have you on more because as weeks and months go on and this unfolds, as I feel, and I certainly think you do as well, as it may just well, we'll pick your brain to see where you're at that point, and also more discussions as to some solutions that you might have as well.
Yeah, for sure.
But Fred, thanks so much. This is a real pleasure. It's a real treat to be able to get people that have real world experience working on a bond trading desk for a major investment bank in the U.S. And to be able to share some discussion and ideas, even if it's difficult. I mean, once again, this is the time for people to get educated, do some homework right now, and ask those tough questions. So thanks, Fred, for being part of that.
Thank you. Thanks for the invitation.
Awesome.
Cheers.